I hope you guys had a good morning so far. Again, obviously, no morning stream today. There was no point in trading pre-Powell here. There's never really any point to, especially if you're trading options. So now we're here. So here we go, guys. We have a couple of things that I want to kind of go over with everybody. Before we get the interest rate decision, which obviously I expect there to be no interest rate changes. I think they're going to keep it flat. But welcome. Let's wait for everybody to filter in here. Again, guys, if you wouldn't mind tapping that like button on your way in. It is Powell Day. We are ready to have a good time and see where we're going to head into the end of the year here, everybody. This is going to be a very important meeting. Last meeting of the year. You're starting to see a little bit of pressure from the Treasury. Janet Yellen kind of saying, yeah, if rates are this high for that much longer, it's going to put a lot of fiscal strain on the overall American economy. Because remember, there's $7.6 trillion of United States government debt that needs to be paid back next year, and that's a third of all of the outstanding debt. If they refinance at higher rates, spaghetti-o, America is in trouble. So they do not want to do that. Let's see here. Who do we have, everybody? Let's see. Let's see, team. Hopefully you guys are having a good morning so far. We're going to have some fun. Or it's the afternoon now. I'm always live in the morning. Always live in the morning. If anybody's new from over on Instagram and TikTok, shout out to you guys. We have been blowing up over there, man. Blowing up. Let's see. Nature's Barista AR guy. Bezos, what's up, team? How we doing? How we doing? Yeah, there's really nothing. Like, there's no reason to be trading around before Powell. Like, that's, to me, that's silly. It's really, like, at that point, like, if you're trying to, like, make money on a Powell day, it's just desperation. We were talking about this a lot yesterday, the systematic versus discretionary trading. You guys need to hear that. Let's see. Where's Telly? Yeah, the other thing, too, is so, all right, we're going to go over a couple of things here, team. So yesterday we had CPI data. This morning we had PPI data, which was relatively good. But yesterday with CPI, with the month-over-month coming in at a 0.1% increase, that gives Powell, and it leaves the door open for him to be a little bit hawkish today and kind of lean into that higher for longer stance. Now, Powell's no dummy. He knows that we're definitely going to be cutting rates at some point next year. Nobody knows by how much really yet. And you guys have heard me say this a couple times before, that I don't think we're cutting in March. I think May is the earliest time that we could expect a rate cut. And then June is really like, all right, I would say for 100% certainty, we're going to have at least one 25 basis point rate cut by the conclusion of the June meeting. That's what I'm expecting here. So going into this meeting, though, the last meeting of the year, he might kind of wrap things up and give us a little summary of where we are, which he kind of does always. But if you think about where we are, it's like, I mean, this is the other thing, too. If inflation, all right, so if the actual long-term inflation target goes from 2% to 3%, that is, it's so bad. It is so bad for the overall, well, it depends. If you're a higher income individual that it has some level of financial literacy, you're probably going to be set up pretty nicely. But if you're not, and you're just an everyday working class American, you're going to get absolutely screwed. Like, absolutely screwed. Because, like, people look at inflation and the numbers that we're seeing right now completely wrong. Like, you'll see people on Twitter be like, oh, inflation's coming down. Why aren't prices increasing? Oh, my God. When inflation comes, if the inflation rate or the increase of prices goes from 6% to 2%, does that mean that prices are coming down, or does it mean that they're just increasing slower? It means they're increasing slower. So the prices are still going to increase, but wages probably are not. So if you're an everyday working American, like, in inflation, the long run expectation goes from 2 to 3%. The effects against you are compounding. It's terrible. Nature's Barista, I honestly don't, like, doesn't really matter. We're going into Powell. It literally does not matter for really anything. And again, guys, well, as you guys are filtering in, if you guys wouldn't mind hitting that like button, helps out a whole lot, getting these streams out. I mean, again, we're live every single morning. We start at 9, and then we go, I always say we're going to end at 10, but we always go later. PayPal has my attention over here. I like this. Traded this on this break to the upside here, made about 600%. Let's see if this thing can do it again. It's been overly beaten down, looks decent. Market's been it's not, I don't know why I said the market, but in general, this thing's been holding up. For those of you guys on the weekly newsletter, yes, you guys have been killing it, man. I mean, Palo Alto, this one, absolute rocket ship over this level here that we were talking about. The Affirm that we were talking about for 2 weeks before the stock went up like what 50%. That was nasty. Mara, PayPal, DraftKings, like it seems like every week we've been throwing you guys some gems based on rate of change over a period of time. Well, month over month can show decreases, but in general, when you're looking at it, well, remember we were talking about this too, Ralph, when it was like it used to be like 2 years and now it's 1 year and then month over month. It's all sorts of nonsense, man. All sorts of nonsense with the data. So we got about 25 minutes to go until the report comes out. TLT's up a little bit today. That's nice. Back above 95. I still like that thing for a longer hold. Yo, UVXY shooting around here. Yeah, if you guys have any questions about anything, let me know. I mean, we're really just sitting here waiting for the for that announcement to come out. What else did I see today that was interesting? The Janet Yellen stuff is really catching my attention here. Oh, this was the other thing too, the Nikki Leaks tweet. Based on the November CPI and PPI, headline PCE inflation, and for those of you guys that don't know, PCE inflation is the Fed's preferred metric to track inflationary pressures on the market. It's not CPI, it's not PPI, it's PCE. Core PCE inflation is projected to have been a very mild 0.06% in November. This could lower the 12-month core PCE index to 3.1. The 6-month annualized rate would fall to 1.9% below the Fed's target. Core CPI was 0.3% in November, which means you've got to watch those wedges. Everything broke well for the PCE this month. The PCE index and the CPI are constructed differently. Forecasters can reliably estimate the PCE released late in the month once the CPI and PPI data are out, which is exactly what's happened. Am I still in snow? No, not in snow. Out of snow. Can I get my thoughts on you? Yeah. I mean, this kind of looks like PayPal here, which is fine. This is the initial. Yeah, you would have gotten stopped here, but yeah, I'm not the biggest fan of this one. This is just kind of setting a nice uptrend here. I really would like this thing to flatline. You had a question? Right, and I said that they don't matter, especially going into Powell. Have I ever tried trading on Bollinger Bands? No. No, that kind of stuff, to me, it makes no sense. If you were to... So, this is the thing. If you're going to use something like that, Trev Trades, you need to create a strategy around it and then test it. If over a 20-year time horizon it worked, I would do it. Again, I don't actually care. This is the thing. I don't care what the strategy is. If I can actually create like a little system with different parameters in it and then run data through it and see if it works or not, I'll trade it. Sometimes I'll automate them. Like I have one of those strategies that's getting added to the Day Trading Mastery course for you guys. Like the one that's already there is at 0 losing months in 2023. It's absolutely filthy. You guys have seen it in the TikTok, Instagram, and some of the YouTube videos here. But this new one, once I share with you guys the rules, you could automate it if you really wanted to. And I know, well, I don't want to say I know for a fact, but I'm like 85% certain that many, many, many large institutions are doing this as well because of where volume comes in. You can see it happen every single day, and you're like, whoa, that's a bit weird. Why does that happen? So when you find the answers to those questions, why does that happen, and then or why do you think that happens, and you test it, and you come to a conclusion, there you go. You have a money printer, which is what I'm handing to you guys in those series over there. Well, let's see. TLT screwing around, ES doing nothing. Thanks, no problem. No problem. What else am I looking at that's interesting? I think that's it. I mean, we have Powell, and then C, we're going to set the tone at the end of the year. I'm not really that interested on doing much in terms of day trades or swing trades going into the end of the year here. Just, like, why? You're going into the holiday time. This week's, like, futures rollover, so even though there could have been some decent volume this week, it's split between two contracts, so you're going to get some weird moves. And then also going into Powell, you're going to see some weird volume as well as people either are last-minute positioning or they're not doing anything because they're already positioned. So, again, it's just kind of lower probability environments, I would say, for in general day trading. So if you want to sit it out, go for it. Again, less trades, more profits is the name of the game. Let's see here. What do we got here? Nothing. Nothing on the feed. Let's see. I mean, I have some hedges out here that are starting to look decent, but they're longer term, and they make sense at these levels in the market, so we'll see what happens with those. The TLTs are still cranking, looking good. Tell us a story. I could think of one. I could think of a story. I told you guys a really good one, like my first day back. That was probably one of the best stories I've told you guys. About the old mob boss that said he was gonna do, you know what, to my... He wasn't a mob boss, he sold crack. So that was a fun one. You wanted to use Bollinger Bands to trade mean reversions? Well, that's typically how they're used. You would just have to craft a strategy and then test it. And again, most of you guys backtest incorrectly. Like, because then you use your discretion in backtesting. Like I can do it just because the strategies that I'm using are so just like, it's just conditions. So like, it's not hard, but most of you guys are going to be like, ooh, maybe I would have done this. And then your data's all screwed up, and it's not going to be the same as when you're testing in a live environment. Like, you have to pay for data. You have to do all sorts of stuff. You got to run out, like, bots through the data and things like that to actually make it make sense. Also, don't do any of that on options, because it'll never work. There's too many variables. The only time you would want to trade an algo would be on, unless it's an option selling algo, but you would want to do it most of the time on futures because of points of points, it ticks a tick. Let's see here. PayPal, a little pop there. I mean, it doesn't really mean anything going into Powell, but popped up a little bit. TLT just been selling off the highs. Backtesting has an original thesis that creates a bias. If you backtesting correctly, yes. And then you guys all saw it, like, because I don't take backtesting or data lightly. Like, when you guys go through the day trading mastery course with the strategy that's had 0 losing months, well, you can see that even when it's like a 50-50, it's like maybe it would have hit. Nope, counted as a loss. You make it harder for that strategy to have success, and then see if it's going to. That's how you do it. You try to put it in the worst conditions to see if it's going to perform. And if it performs, then you have a winner. Any chance you could show us how to open multiple positions at the same time on NinjaTrader and said have to close the first CP, good loss? All right, Daniel. I mean, I don't even have it open right now because I'm not trading. I'm not going to load it up. But all you do is in the top, there's a contract quantity thing. So you just change the quantity, click the screen somewhere, and it'll say like sell stop, sell limit, buy stop, buy limit, and then you just set it there. But you also have to make sure that if something gets hit, you then have to manually cancel the other sitting orders that are out there. Because if you don't, they're just going to stay, and you could think you're out of a position, but you actually have sitting orders out there, which is a problem. Which when I started screwing around with futures, good thing. I mean, again, that's why I said I was like, what was that? Way earlier this year when I started to trade a lot more of them. I was like, I'm just going to screw around with it on a paper account for like a week or two and just see, like, get used to the broker. And I did that a few times where I would like just be done doing something, and then the next day I'd be like, what the heck happened here? And then I'd look and I'd be like, oh, I had the order. And then you realize, like, and you get it into your system that like if you hear a sound or anything, you just spam the cancel button, which is what I do. I literally like you guys don't see it in the videos, but like if something hits, look, I'm moving stuff very quickly. Yeah, exactly. Right, Ralph. Options are for DJ days and futures are for business days. Nah, you wanna swing options, day trade futures. That's what you want to do. Well, that's my opinion about what works best, and the reasons why are: one, if you're gonna catch bigger moves, and well, I mean, it almost doesn't matter. Like with the swing strategy that I give you guys, it's effectively the same thing unless you catch a weekly. Any sane strategy is good as long as you have risk and emotional management. No, absolutely not, Trev. Absolutely not. There are strategies out there that are they just don't work. Like if you have a certain set of rules behind it, it will not make money over time. All your job is as a trader is to find the ones that do, and then just like most of the stuff that I do every single day, guys, could be automated. Swing trades, not as much because I have to go and hunt for them and go scan and look for things. But like anything that I do with day trades could be automated. Which, they might. And then when I add that next portion of the Day Trading Mastery course, if you guys wanted to automate that, you could. I already have 20 years of data backing it. I'm about to get the next 10. So like 30 year. And the 120-year block, if you compare the two ways that people would do it, I'm not going to explain it. I can't explain it, but like the way that the correct way generates, I think it's 633% over that time frame, and you literally don't have to do anything. The I buy a call strategy doesn't work. Right, exactly. Like we were talking about, it was like, oh, it's down, buy call. It's up, buy put. No. That's not a strategy. 80% loss trade and 40 million or something like that? Yeah, because his strategy worked. Like, Trev, think about it like this. If his strategy didn't work and he had an 80% loss rate, he would lose money. His strategy worked with testing, and he already tested it. They're all doing the same thing that I am. Any pro trader on Wall Street, any money man, they're all doing the same things that I'm handing you guys in that video series. Like, imagine if his strategy didn't work. Oh, well, then he wouldn't have made 400 million. It's not that it's like, oh, you can do anything and then just like risk management, whatever, and you'll make money. No, that's incorrect. Next thing you know, folks will replace you with ChatGPT. They can't do that. ChatGPT is censored. I have an interesting project. I mean, it's not going to be over here, but I have something that I'm going to be doing kind of on the... I have a lot of things going on. I mean, people like were calling me on the morning stream yesterday, and I couldn't answer. I was like, I gotta answer these calls. All right, guys. Oh, man, you guys are killing the like button here. Thank you, guys. I appreciate that. Pro traders with very high loss rates take very small losses and very large gains, type soft losses every time. Right. It's the same thing with like my swing trading strategy that I teach you guys. Anytime that I lose a swing trade, it's tiny, but anytime I win, it's huge. 500%, 600%, 1,000%, 2,000% every time. Why? Well, that's what the strategy does. That's what it's built to do. Like, and then even the day trading mastery course that I have for you guys, it's, what do you call it? Like, you guys have seen it. It's like the average risk to reward is like 1 to 6, 1 to 7, 1 to 8. Sometimes I hit 1 to 10s and they're nasty. But the win rate is what? 35, 40%. Right, but it doesn't matter if you're hitting average 1 to 7s and you only need 1 divided by 8 in order to be profitable. You're just creating money printers. That's all you're doing. If you're day trading, you want to be trading with systems, not discretion, which is why most traders fail, because they trade with discretion and not systems. So we got about 12 minutes to go until the FOMC here. You're gonna get riot calls. I'm done on the Bitcoin stuff. I already nailed Mara and everything. I was hunting that trade for a while. I can show you Mara, the one that I traded. I think it's still on my chart. I don't hate this if this were to flatline for like 2 weeks. Buyers need to hold it up though. But I can show you the Mara trade that I took. See? You guys all had this one on the free video newsletter. It's up to you guys if you wanted to take advantage or not. So this one was nasty. So this was the 1,200% one from back in June. This was the Mara one from recently where you break the 1066 area, stop below this low, hits 2 TPs, and then I was out right here. And it says it's garbage. Well, Trev trades, it doesn't necessarily matter what the win rate is, because if the risk to reward is if the risk to reward's high, it can balance out over time and make you boatloads of money. What you got to think about is the strategy doesn't matter. The only thing that matters is if it works with data over time and you can actually trust the data, which most of the time is like you can't, because the rules aren't as clearly defined as they should be. Well, again, for all you guys on the sidelines there, if those of you guys that have downloaded the free ebook and have hopped into the the free video newsletter in your emails. I've sent it to you guys twice. You guys have 50% off for this month to the Day Trading Mastery course. And then for everybody else here, the code's STV30. For those of you guys that want to hop in, get handed just a consistently profitable strategy. Again, we backtest it. It's very, very strict data, and it's just an awesome tool to add to your arsenal there. Less trades, more profits is what you guys need to be thinking about. If you're taking like 4 or 5 trades a day, I just would almost guarantee that you're going to fail over the long run, because only a very, very select few individuals have the ability to do that. Talk about summary of economic projections. Well, isn't that should be coming out in 10 minutes. It's not now. I believe that comes out within the report. So, yeah, you guys have that code until the end of the month. Make sure you guys are taking advantage of that, because after that, the price is going back up to what it's listed at. What's up, buddy? What's up, Hot Potato? How you doing, man? Hot Potato, I heard you've been crushing it, buddy. Congratulations. Well, I'd love to see that, dude. The growth out of you. I mean, I was talking to Gabe, and he was like, dude, HP's killing it. I was like, fuck yeah, he is. Sorry for the language, man. My bad. Sorry. I just like Hot Potato, even though he almost got me arrested. But it's cool. Alright, let's see what we got here. But do listeners know what it is? We'll go over it when it comes out. PayPal coming up there. Hello. Hola. We don't really need Mara up here. I kind of want to see what UVXY does on Powell. That was your fault? It was not my fault. I feel like I saved the day there. You're gonna need to spend entirely freely. Oh, that's awesome, man. What time is it there? You just trade large cap, follow the big money. You can't follow the big money. That's impossible. People will say that it is possible, but it's not. And what a lot of people cite is flow, like large unusual options purchases. That actually doesn't give you a conclusive answer into what's happening. It's like midnight. Jeez, man. So that actually doesn't give you a conclusive answer into what's actually happening in the market. The only thing that does, because you can cherry pick it. That's the problem. I could go out and cherry pick options, like unusual options all the time, and just be like, look. I've heard this a few times, and I've said it to you guys a lot. The only way to guarantee and have a conclusive answer into what big money is actually doing is if you can sit across the table from the decision maker and can somehow guarantee that they're giving you a truthful and honest, accurate answer, which nobody does. Nobody has the ability to do that. So does it have its place? Sure, but it's not a conclusive answer. Let's see here. What do we got? 7 minutes to go until Powell. All right. You also don't know if they're getting bought or sold. Like, there's a lot of nonsense there. You're just guessing. You're like, ooh, look, guess. Not for me. I don't guess. You guys see the thing I put on the Instagram story? The thing from Goodwill Hunting? Where I was like, it was like, what was it? I don't know. You guys saw it, but price action is king then? Yeah, I would say so. It depends on it. Like, it depends. Like, I don't actually care. And this is something that a lot of you guys should think about too. I don't actually care what the market does ever on an intraday basis. I don't have any bias going into any day. I don't care. The only time that I will use my discretion, and we talked about this a lot yesterday, was on the medium to longer term trades, which is then you can look at the overall macroeconomic conditions, see what most people's assumptions are, and then also put then your own knowledge into it to confirm or disprove that thesis. That's when discretion makes sense. Not on a 5-minute candle. But that's why I just hand you guys those data-driven strategies. You guys are gonna get another one soon. I just have to what do you call it? Get the second 10 years of, not the second 10 years, but 10 years of additional data to it. So then it's 30 years of data. And then it's just, here's another one. So and I have a couple more too that I'm going to hand you guys. So the value within that video series up there, it's already like 23 videos for you guys going over futures, options, risk management, psychology, everything. So all those little nuggets that you guys hear me say on a day-to-day basis, well, I took the time and sat down and thought out for hours the most important little bits and pieces of that and just condensed them into that video series for you and just handed you guys some sick strategies. So there you go. When rug, you want another Jackson Hole day? It could be today. We got 5 minutes to go, everybody. This one could get interesting. Where's my stuff? Here it is. I don't know. I have like I'm probably not doing anything here. Muhammad, I don't know what you did. I don't know what you did on what stock, but which ticker was it, buddy? Because I hope you crushed it. I mean, I don't. Well, if you're on the video newsletter and those tickers, I mean the success rate of those that I've been giving you guys has got to be like 80%, 70% on the tickers that like actually break. I can only really think of 2 or 3 that failed. Affirm? Nope, not Affirm. Sorry, Affirm was probably the best one. Snow? Chegg is still yet to be seen. Upwork wasn't great. And then I think there was one more that I remember that broke and then came right back. IONQ, I think. So 3 of them. But then you got like PayPal, Affirm, DraftKings, Mara. All multi 100%ers. So, Muhammad, I'd love to know which ticker you were trading, buddy. All right, 3 minutes to go, guys. And again, if you guys wouldn't mind, as you're filtering in here, tapping that like button helps out getting these streams out to some more people. Whoa, Telly getting a little action before Powell here. I mean, it's not Powell's at 2:30, but we're going to get the interest rate decision in the SEP summary of economic projections coming out in 3 minutes. That movie made you tear up. Good Will Hunting. Great movie, man. Great movie. Happened right over there. One of our friends used to PayPal. Hello, buddy. One of our friends used to live in one of the Good Will Hunting houses. Jack's dad, what's up, man? How you doing? All right, folks. PayPal coming up. Telly getting a little spicy here. Is that ES moving too? Yeah, ES is moving too going into this. So we got 2 minutes here. First round. Then we have the most important thing, which is going to be the prepared remarks and the Q&A session with Powell. Because there's going to be questions on either side about people with their own personal, or not personal, but like overall like ideas of how the market's looking right now. Because there's so many different variables that you have to account for to kind of figure out where we go next. And the Fed and Powell is the only response is, I don't know, we'll wait and see. That's really it. All right, so this is I've got ES on the 15-minute here. It's not really, I mean, if we really wanted to have some fun, we could look at it on the 1 minute, but I don't think that's useful. So we got 45 seconds here, everybody. Welcome to FOMC day. We're going to have some fun. Should I degen trade it? No. Will I? No. No, it's not worth it. Why do it? Like, it's like once you understand like how important systems are and data are in the market, doing anything other than that just makes you feel ill. But you feel great because you're making more money consistently. So it's a good trade-off, man. Good trade-off. And that's like when people say like, oh, discipline's so hard in the market and all that stuff. It's like, it's not. You just are looking at the wrong stuff. 3, 2, 1. Boom. Whoa. Big boy candle here so far. All right, let's keep an eye out on the news feed. Fed holds benchmark rate at 5.25 to 5.5% with no additional rate increase there. Bing, bang, boom. What the? How does that make any sense? Oh, it doesn't. That's why. That'll adjust. Why did my UVXYs just jump? PayPal running. Yeah, that doesn't make any sense. Those are just longer term hedges that I just keep around. PayPal running. Puts? Oh, you like to gamble, huh? Most Fed officials see rate cuts in 2024. Fed says inflation eased over the past year but remains elevated. Oh, here we go. Hold on. This could get interesting. Market's ripping. FOMC median forecast shows 75 basis points of rate cuts in 2024 to 4.6. Wow, that's 325 basis point cuts. Market's gonna love that. Fed will assess the well, I think we already knew that though. I think we already knew that. We'll assess the extent of any additional firming needed. Yeah, they have to say that. FOMC median 2024 PCE core PCE forecast declined to 2.4%. That's big. That's what Nikki Leaks was talking about earlier. Remember, this tweet right here, based on the November CPI and PPI, headline PCE inflation likely declined last month. Core PCE inflation is projected to have been a very mild 0.06% in November. This could lower the 12-month core PCE index to 3.1. And what did this say? What was it? 2.4. Whoa. But I mean, it's different ways of looking at the data there. Fed officials see lower inflation, slower GDP growth in 24, 75 basis points of cuts. Yeah, so TLT should be ripping on that. Yep, there we go. There we go. Telly. Hello. Nice. Fed voted 12-0 for Fed funds rate action, so they were all in agreement on not raising rates at this meeting. That's to be expected, but also very important. Just hit your calls. Oh man, you gambled and you won. Good for you, but I'm happy you guys make money, but sometimes I'm not happy that you guys don't trade with systems, because it's like I can lead you to the water, but I can't make you drink, man. Let's see here. PayPal running. Tally looking decent. Is this isn't all-time highs, is it? No, it can't be. Can't be. It's probably getting up there, though. Is that all-time? Yeah. Yeah. 4408. Oh, we're like 100 points away from all-time highs. That's so drunk. They're going to cut rates at the market at all-time highs next year. That's so ridiculous. Oh, wait. On SPY we are? No. I thought we hit like 480 or something. Wait, 466? I thought we were higher than this. No. You're wait. Yeah, 479. So you're about what? $13 away on the SPY? No. It's not that close. So you're like $13 away. PayPal looking good here, though. That's on the weekly. We don't care about that right now. Now we just have to see if this thing's just going to knife when Powell opens his mouth. Which I wouldn't expect it to, but uh-oh. We got some slackers on the like button here. Over 100 of you guys haven't hit it yet. Don't be a slacker. What did this do? Okay, that's cool. That's cool. All right, now we get the most important part. So make sure you guys stick around, because we're gonna get the the Powell's prepared remarks, and then we're also going to be getting the Q&A session with Powell, which I'm very interested to hear. Very, very, very interested. So we got about 25 minutes until that starts. So just kind of seeing how things are gonna fare over here. PayPal day high. That's what I like. U.S. 2 to 7 year yields experience a decline of over 15 basis points on the day following the actions by the Federal Reserve. All right, so here's what this means, everybody. So if bond yields are coming down, it's a really interesting point in the hiking cycle for this to actually happen because it's showing more demand for U.S. Treasuries. Why? We talked about this in the TLT video that I made for you guys, but the modern portfolio theory, the classic 60-40 bond portfolio, is making somewhat of a comeback with yields this high. So if investors are going to start locking in these higher rates for slightly more extended periods of time, even if it's like these shorter durations, it's still a sign that there's demand for government treasuries. Well, again, what does that do? It pushes yields down, which then benefits TLT. You get rate cuts, it could benefit TLT. The only thing that I foresee is being weighing down on the TLT thesis is this $7.6 trillion of debt. Still holding longs for tomorrow's gap up. It's almost like you say that it's a certainty. We still have Powell to get through. This is nothing. This is all this is all we've already expected, like the data to come out. I didn't necessarily expect the market to react like this. How many points is this here? About 20. Wow. 22 points on this 15-minute candle. Dollar moving lower. Yeah, that makes sense. Yeah, rock bottom. I mean, again, you can gamble all you want in the market. That's perfectly fine. But I trade based off of systems and data. I don't really use my discretion ever. I will take maybe 2 or 3 trades per year in which I use my overall discretion. Now, the reason why I'm only doing it 2 or 3 times per year is because, well, again, with like 10 years of looking at market data and analyzing markets or everything, get a good idea of what's about to happen next. But there's no real reason to allocate capital. I mean, it's like to allocate capital to nonsense. Like if I see a good macro trade, I'm taking it. But those come around less often. We got to be prepared for when they do. So, and then for day trades, it's all systems. I'm never in control of the day trades. What is? My system. So again, remember, you guys have until the end of the month to utilize that 30% off code STV30 for the day trading mastery course. I still got to change the name to the less trades more profit. But once I add like the new strategies that you actually could code into an algorithm, the name then would make sense. So May rate cut now 90%. There you go. There you go. So I think May. I mean, they're going to up the expectations for March, but I don't think March is likely. I think it's too early. In terms of the data, in terms of what the Treasury is going to weigh in on, I don't really know. It could be interesting. Long end getting a bid too. Well, most likely they're all getting a bid at the same time, but let's take a look at the 30. Yeah. Yeah, long end's getting a bid here too. Look at that candle. So this is the 30-year Treasury or 30-year government bond yield. So they had the auction yesterday, which was very important, and I was actually surprised that auction came in good. So I was in a short position yesterday, just based on my system, but obviously I know when the 30-year auction is happening. So I was expecting, especially after CPI data and things like that the auction wasn't going to go great. So it almost added to the system and the thesis that I already had. It didn't happen. Got stopped for a tiny loss. Bing, bang, boom. Done for the day. Thank you very much. But it doesn't matter because the strategy's had 0 losing months in 2023. So do I care about the outcome of any individual trade? No, I don't. I care about what happens over a quarter, a year, 2 years, 3 years, 10 years, 5. Like, that's what I care about. I don't care about the outcome of one trade. Oh, yeah. So, Ralph, I see that now. U.S. interest rate futures raise odds of May rate cut to 90% after Fed decision versus 80% before. Gold extends gains after the U.S. Fed. That makes sense with the dollar selling off. PayPal trying 60. Yeah, I have a PayPal position. That was kind of a fun one. I've liked PayPal before big data events. Recent, like the last one was a little bit of a CPI trade there, but PayPal looked nasty. So when you look at this is, and we talked about this on the video newsletter for you guys, which is free, remember. If you guys want to hop in there, get the free ebook and then the video newsletter, just go to shortthevix.info and you guys can hop in there for free. But this is the day that I bought PayPal, this little inside bar here, and then boom, 600% off after the October CPI that was released in November. Smaller size, obviously, going into CPI, but I liked this setup anyway. Thoughts on Carvana? I nailed it. You guys saw me nail that thing for about, 100-something%. I'm out of it now, so I don't really... It's setting up again, though. It's actually setting up a better trade for me. So this will be something that we talk about on this Sunday's newsletter with you guys. I don't hate this. So I traded this break here. So this is the day that I made, and we basically sold the top there too, which was awesome. Left some out there for free. Started to come back down a little the next day. I just exited it because I was like, why bother? Up 30% on PayPal, size for 0. There you go. Somebody's paying attention. There you go, Reaper. I mean, I don't know when your expiration date is. Mine's a little bit further out. Because there's a lot of things about the PayPal story that I like right now. Ralph, this is what I was looking for. U.S. Fed rate futures raise odds of March 2024 cut to more than 60%. So May is still at higher odds than March. I don't think they're cutting in March. Yeah, SPY is not at its all-time high. It hit like 479 in, I think, January of 22. Yeah, Carvana is actually setting up a potentially bigger move than this. That's why I don't like trend lines, man. Like, I hate them. I hate trend lines. I think they're silly. Because if you were trading options on this thing and you were using the trend line as your stop, you still wouldn't be, you'd be toast here. Toast. January 24. Nice. Where's last Sunday video? It's emailed to you, so make sure you guys are checking your emails. It gets sent out at noon on Sundays. And then we do the stream at 2. Let's see here. Delayed data, maybe? I don't think so. Look, I'll show you right now. SPY. Weekly. See? Right here. 479. The height of this candle, 479.98. You've got some room here. PayPal pushing 60. There we go. You're still struggling to see more than 3 cuts in 24? Well, that is 3 cuts in 24. 75 bips is 3 cuts of 25. Does my course include live trade? No. You don't need to. Like, you don't need me there guiding you through it. The video series gives you everything that you need to know. You guys don't have to pay me every single month to tell you the stuff that you can see very easily in the market. Why do that? I don't want your money. Just one time and you guys are good to go. And then I continuously add new strategies to it that are all back tested and everything. Paulo, sorry. Nice to see you back in the streams. Hope all is well. Thank you, buddy. Hope all is well with you too. Yeah, but you guys all get 30% off until the end of the month. Just on the little launch of it. So if you're interested, take advantage of it. I'll try and add the second strategy that you could code into an algorithm very simply. By the end of the year, I don't know, because I'm not going to be around much next week. So it'll probably be January that I release the second, like, block of videos in there for you guys. Where's Alibaba? Telly's looking great. Still, it's screwing around at the lows. Oh, AJ, no. Two completely different things. Two completely different things. You don't have the video from last Sunday? No, you do. It's in the email. You know, TradingView and Webull? That's weird. I mean, I pay for all the data, so I think, you guys should have it. Conspiracy. No. I'm just going. Let's see. UVXY screwing around. This is still go. Where's PayPal here? Is PayPal making new highs? Is she? Is she? Where's this level from? Why do I have this red line on my chart? Why is this here? This makes no sense. Go away. Okay, thanks. No problem, AJ. Yeah, and again, once you guys hop in there, if you guys have any questions about anything, just ask. I'm always around. Just shoot me a message on either like Insta. Try to not do it on TikTok because I'm not always on there, but like Instagram or Twitter, and you guys are good to go. Why does a girlfriend from 3 years ago keep messaging you? There's a really simple answer for that I'm not going to say on the stream. It happens, bud. Let's see here. The Fed has arrived on Soft Landing Island. I like that. What's this one? I get. You'll send me a screenshot of the email. There's 2 links in it. It's the first link. But yeah, send me the screenshot, Wayne. We'll see if there's anything weird over there. Whoa. U.S. 10-year yields fall to lowest since August. Last down 12.5 basis points, which is 0.1%, at 4.08. Telly should be higher than this then. If the 10 years making low, if all these yields are making lows, TLT should be higher. Where's TMF? 59. So so this had a reverse split, which I believe is was done because they needed to make it easier for them to like hedge and actually create the leverage in this ETF. But I was talking about this thing below 4, right around 4. So if it was a 10-for-1 reverse or 1 to 10 reverse split, however you want to say it. So that would be from like right around 4 to 590, which is a 50% increase from when we were talking about this. Absolute gem there. Oop, that is TMF. I want TLT. Eric, yeah. Does Teachable let us send you messages? They might, but just send me messages on like Instagram or Twitter. It's easier for us to all see it. All right. Where's this stream link? All right. Got the link. Not gonna. Wait, hold on. All right, cool. I don't like the elevator music that they put on, but like, listen. Or I mean, you guys might not be able to hear this, but it's very annoying. I've learned more from Vix in 3 years than I've ever learned in my 20 years of schooling. Thank you, friend. Merry Christmas, Vix. Jack's dad, I appreciate that, man. Thank you. I try to give you guys the knowledge that you need. There is a lot of stuff that I hold back, though. Okay, so I'll tell you guys this. I go down like rabbit holes sometimes and I just learn stuff. Like I just learn a lot of different things. Some of them could be relevant to this, but some of them aren't. But I kind of have a new project that I'm going to just like take all that stuff that's in my head and then put it out into the ether, and you guys will probably run into it at some point. Kangarooish? I think he's going to be pretty kangarooish. He'll lean. I honestly don't know which way he's going to lean here, but we got 10 minutes until we're going to find out. PayPal, running. What am I up on these? 34% on PayPal so far. Nice. Nice, man. Yeah, Wayne, it's different. Search for Shortavix917. That's the email address that it's coming from. No, that's not my dad. That's not my dad. Everybody always says that. I'm like, no, he has another son named like JAX, I think. Which is kind of cool. All right, we got to move some stuff around here so I can get the... Got my multivitamins, which I don't know why they're over here. Those are stale. You got to get new ones. Thanks again, buddy, for all the knowledge you've given us in that time. Been around since college. Call it's Mikey Alarms. Keep it up. No problem. Oh, yeah. Thank you, buddy. I appreciate that. The 24-year-old version of my brain. I go on some, some of the stuff that, like, you find sometimes when you just search for things. It's like, whoa, I don't think I'm supposed to know that. And then you're like, oh yeah, I can't say this ever. Why is UVXY bouncing? That's weird. All right, guys. We've got 8 minutes to go until we get to hear from Papa. Papa Power. Hope you guys are ready. Oh, his name is actually Jack? Oh, that's pretty cool. I'd love it if PayPal gave me another gem, you know? Cootie, what's up, buddy? How you doing? I think we search and find similar things. Oh, I bet we do. Oh, I bet we do. KORU, what's that? Why are we looking at Direxion South Korea bull ETFs right now, Ralph? Why are we looking at 3 times levered South Korea? Do they have an Argentina one? Hold on. Does anybody know if they have an Argentina one? Because if they do, that thing's probably up like 2,000% this year. Is there a 3 times levered Argentina ETF? Hold on. Somebody find that. Because if you look at the actual chart of like the Argentina... Or no, Venezuela. Sorry. It's not Argentina. It's Venezuela. Hold on. 3x... It's Venezuela, not Argentina. Hold on, I'm trying to find one. Wait. That's not it. Because if they have one, it's a BRZU. Yeah, but it's not Argentina. Or Venezuela, sorry. Hold on, I gotta show you guys this. This is hilarious. IBVC, it's this. So it's up. That's 1 day. I need 1. What the? 1 year. It's up what? The main stock market index in Venezuela, IBC, increased 35,000 points, or 167.3% since the beginning of 2023. That's ridiculous. They would just nationalize it and ruin it? U.S. banks are already nationalized. But they don't want to talk about that, do they? Yeah, Argentina devalued yesterday. Yeah, that's why I have Argentina in my head, because I keep seeing clips of the new president all around. But I'm referring to Venezuela. Okay, well, this is cool. We've got the 3 times leveraged South Korea bull ETF up here. I don't really think there's much we could do with this. What did we? Is this PayPal? Yeah, looking good. David called the Venezuela move. Nice. Tor, what's up, buddy? Yeah, I bet David would. David's a smart guy. I gotta talk to that guy at some point. Smart dude. Wow, we're like 25 likes away from 100 on the stream. Thank you guys. I appreciate that. You guys are crushing it today. It's Powell Day. We're gonna have some fun. I'm excited for this. And then you guys just gotta let me know if you can hear it. You should be able to, because I'm not on Restream. All right. Why is this down here? 92.83. Oh, it's a gap. That's why. I know what that is. I should label some of these lines on my chart sometimes, because I just forget why I put them there. And then I look back, and I'm probably having one of those moments where I'm like randomly looking. Biden needs a win for 2024. Well, whatever you want, man. If you want to vote for him, it's your vote. Ankles at 100? No. All right, we got 4 minutes to go. Give me like 2 seconds. I'm going to grab some water. Yeah, just give me like 2 seconds. I'll be right back. All right. What's up, team? What up, Eric? How you doing, man? And guys, remember, I'm live every morning again, 9 a.m. to like 10:15, 10:30. So if you guys are around, make sure you guys are coming and popping in the morning streams. We have a lot of fun over there. What do we got here? Interesting. In September, the Fed saw 2 cuts in 2024, 5 cuts in 2025. Now the Fed sees 3 cuts in 24, 4 cuts in 25. So they're at, whoa, they move. That's why the market's reacting. The dot plot. He's doing all right, man. He's doing all right. Corey was a David call. You know me, man. I just don't like 3 times levered ETFs. I don't like that in biotech. And if you have a 3 times levered biotech, my brain explodes. I'm just like, oh, I just don't like biotechs. People have, people have their strong suits. Like if you want to play around with 3 times levered ETFs and you know what they're doing and you have a better understanding of them, and like South Korea, for example, I have no edge in the understanding the South Korean market. 0. So it doesn't make sense for me to trade it. You'll pop back into some morning streams? Awesome, Moonbound. Love to see you there, buddy. Oh, wait. We got a minute to go until Papa. Here we go. All right, guys. Remember, end of the month here. Last chance to get 30% off the Day Trading Mastery course. So here you guys go. Again, fully backtested strategy. 0 losing months in 2023. We go over risk management, psychology, futures, options, everything. So those of you guys that were on the email list, you guys do have that 50% off code, so make sure you're utilizing that. But if not, I was making a lot of announcements about that, so you missed it, but you still have 30% off to the end of the month. All right. Here we go. I'm just waiting for Papa to come on the screen, and then we are going to sit back, relax, and have some fun listening to this. I don't want to call it just like it's going to be a circus. Here we go. All right. Hold on. He hasn't come out of the door yet. He's not there, but he's going to come soon. Santa's coming! Oh my God, Santa! AR guy, there you go, buddy. When's he gonna come out? Is he coming? Show the video too? No, I'm not gonna do that. I'll get YouTube mad at me if I do that. You guys just get the audio. It'd be hilarious if they were like, never mind. Oh, I see him. I see Jerome. I see
him. Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue. easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic. And ongoing progress.
That's big.
Ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
No, it's not.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
This is important.
Specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so
You said that again?
that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, the microphone, sorry. Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So of course I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully and making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color as to the nature of that discussion today? Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was. There was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing. Preliminary kind of a discussion like that. Not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Governor Rachel?
Perfect.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility because of the unusual situation that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters, a very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where
TLC's up
the
2%.
Distortions to
2.5%,
supply
bro.
and demand from the pandemic,
That's
the
huge.
shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down they basically, each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor, and it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time, but it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election? Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was, 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully, so as time goes forward.
Nick Timrose of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing, back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals, and that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't. But in any case, we have to do what we think is right. And in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we'd look at the total, if we make decisions about policy changes going forward, we're going to look at all those things. and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again.
Right.
It just is. It's the way our policy works.
Go to Neil.
Yeah, Market's like, yeah, right.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, there's just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest that it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire.
Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
that's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And if you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. We're obviously looking hard at what's happening with demand, and what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year, and you see what the forecasts are. I think the median participant wrote down 1.4% growth, but we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, a really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, this, but allow me to say it again. We don't debate or discuss what the right, whose SEP is right. We just say what they are, and we tabulate them and publish them. So it's, it's important for people to know that, but it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress. in core inflation. It has been sticky, and famously the service sector is thought to be stickier, but we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina.
Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecast we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook. Right.
So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Okay, and you see, how are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this difficult, uncertain, really unprecedented environment. Someone once said that the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Go to Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are of course stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and I think you'll see a reasonable estimate of the time lags and things like that it would take.
Do you think below 3% would be reasonable?
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the U.S. economy?
I think this, we felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If there's something different about the U.S. economy.
Yeah, so it's not that, it may or may not be about the U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a participation shock. So this is just very unusual. And, we had the view, my colleagues and I broadly had the view that we could get a lot of, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced, and something like that has happened. It happened so far. The question is, once that part of it runs out, and we think it has a ways to run. We definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it goes down to demand and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down, the labor market keeps getting back into balance, and it's so far so good. Although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we'll go to Megan for the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
That's a good question.
We're not talking about altering the pace of QT right now. Just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or, as a result, or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out, and at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion, We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and
It's probably
so far it's working pretty much as expected. We think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts, is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking though the question. I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight. And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time. Thanks very much.
Wow. That was a very, very important meeting there, guys. So Powell seemed very dovish in terms of his overall outlook going into next year. Now, we've been talking about this a little bit. I didn't expect that. I thought he was going to hold strong at this meeting because the effects of Janet Yellen coming in and kind of giving him that pressure with all that debt that needs to roll over next year, I was kind of expecting Powell to try and calm the market down because all market participants recently have been flying into the bond market, putting their expectations for a bunch of rate cuts next year. And when the Fed then comes out and says, yeah, we're now projecting 3 rate cuts next year instead of 2, that's big, guys. And then the other thing was, too, that I was thinking of is I don't think we've ever heard Powell say that we're basically at the peak. Or he thinks that we're at the peak of interest rates. But then he comes out and says, well, we could raise more. But with the market already projecting a bunch of rate cuts to happen next year anyway, that statement of, oh, we're going to leave the door open, it's almost like the boy who cried wolf, where a lot of these market participants have heard Powell say, big players, what I mean by market participants, big players have heard Powell say many, many, many times since we've stopped raising, oh, we're going to leave the door open for further increases. But after you look at all of the data in totality, it doesn't look like they're actually going to do that, which is why you've seen the reactions out of the market that you have. So that statement from Powell almost doesn't mean anything. But when he comes in and says, oh, we might be, we're pretty much at the top, this happens. Boom. Very interesting, guys. Very, very, very interesting. SPY retracting back puts. Why are you... All right. I mean, we talked about this a lot. Sammy, make sure you're coming to the morning streams. Remember, guys, I'm live every morning, 9 a.m. till 10:15, 10:30. That's usually what we're doing. You need to trade with systems and not to your discretion. That is a fully discretionary trade right there, which doesn't make any sense to me. Those PayPal contracts are cranking, man. I think the highest I saw them at was, I think TLT is going to come down a little bit here. But the highest I saw those PayPal contracts up was 86%. Those are looking good from earlier. Big meeting, man. He came out pretty dovish. So let's see how the market reacts in the end of the day. And I think we could be set up for fun end of the year. Last kind of thing before we wrap it up here, guys, is remember, everybody gets 30% off to the Day Trading Mastery course. There you guys go. The code is STV30. That code is good until the end of the month. And then it goes back up to the normal price. As we add in those other strategies that have been proven to work, the next one is going to be tested over 30 years. 20 years of data is 633%. You could actually code this one into an algorithm too. The one that you guys have access to right now, 0 losing months in 2023, absolutely killer. So if you guys are interested, you're just messing. Good. Popping in to watch the moonshot. Your TLT and Mara contracts are pumping. Nice. I'm out of Mara. I sold it. I mean, I'll show you the chart again of where I was out. It's from the newsletter, but right here. So missed a little bit of it, but that's fine. I was looking for that quick move on this thing. I mean, this was huge. This was about a 6-to-1 risk to reward. Very, very, very solid one there. So yeah, man. That's probably going to wrap it up for us today. And again, for those of you guys filtering in, as you're going through the videos, if you have any questions, just message me on Twitter or Instagram are the best 2 places to reach out, because TikTok, I don't really check. Every once in a while, I'll look at it. Don't get mad when you trim winners. Hey, man, I don't care. It's your money. Ralph, the people who, the people that I talk to sometimes that I would deem to be either have more not information, but a better let's call it more experience with the information. Like they were like, yeah, I don't think rates are going to come down anymore. I think TLT's kind of done for now. And I was like, yeah, no, I'm not. I don't care what you think. I already know. So yeah, man, very, very interesting. Very, very interesting Powell meeting there. Again, I'll see you guys on stream tomorrow morning. We'll be live back again tomorrow morning. We weren't live this morning just because it's Powell Day. There's nothing to do in the morning on a Jerome Powell Day. Wow, Mer, 11% on Mer. How's Baba doing? That one's an interesting one to me for a little longer dated stuff there. PayPal looking good. TLT hanging on here for a little bit. I would expect this thing to falter a little bit. But overall, looking good. We called that thing below 85, 80, really 83 was where I was buying the most of it there. Wish I got TMF, though. Wish I got TMF. So, team, I will see you guys later. Peace!